Performance has been strong. We've generated a very robust absolute and relative returns, significantly outperforming the benchmark, the MSCI. About 25% of the names have changed, but that's just going for higher conviction names. Otherwise, the portfolio is very much facing in the same direction as a year ago. Very high conviction recovery PVT stocks, a significant amount of value, and exposed to parts of the world which are earlier in the cycle. So Asia Pacific, emerging markets in general, Europe. Very underweight the US, where we think the cycle is very mature. The value factor, which is one of our key exposures, buying things when they're cheaply priced versus their historical valuations, that value factor has really struggled for a number of years. Despite that, we managed to generate strong returns. I think because we have a three-factor approach, so as well as value, we're looking for stocks with attractive potential and attractive timing, so PVT, potential, valuation and timing. The potential factor, in particular finding recovery stocks, and the timing side of things, those two exposure style biases have offset the difficult value factor. We enjoy managing such concentrated portfolios. We've been managing small number of stock portfolios for almost 6 years now, and the last year is just a continuation of delivering strong absolute and relative returns from managing a focused portfolio. By definition, a 20 stock portfolio needs to be made up of the highest conviction ideas. Our conviction comes from a combination of Moneypenny, our screening system, proprietary screening system, which screens the world for companies that have our PVT characteristics, and then the verification, the research side, traditional kicking of tires, and the combination of the two enables us to get high conviction. Clearly, these stocks will have particular insight into and particular knowledge. But the key for us is where we're different from markets rather than necessarily the depth. It's the difference in terms of our analysis versus the market consensus, and that creates the opportunity for us to exploit. We do think that the unconstrained high active share element of the portfolio will enable us to generate strong medium and long-term returns. I emphasize the medium to long term because clearly such focused portfolios in the short term can be more volatile. That's why you do need to put our portfolio alongside other managers who are running focused portfolios, exactly like Alliance Trust are doing. These are our 20 highest conviction ideas. They should, by definition, go on to generate strong absolute and relative returns, and those returns won't be diluted by having excess diversification in terms of number of stocks or having exposure to benchmark stocks, which inevitably dilutes the relative returns. The last month has seen quite a volatile period, but the portfolio that we run for Alliance Trust has actually held its own. In fact, we've continued to generate relative outperformance over that period of time. And clearly volatility on the downside does provide opportunities to add to positions, your highest conviction positions, an opportunity to buy those shares at lower prices, so that can be attractive.